The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Good morning and welcome to Winning in Retirement. I'm Brian Akers from Akers Financial Group, here with you today to talk about retirement planning, estate planning, and today's topic is going to be inheritance. And so we brought in my cousin, Jeff Akers, Vice President of Akers Financial Group. Good morning, Jeff.
Good morning, Brian. Good to see you again.
I thought I'd just make it real simple to start. Yes, he's my cousin.
Yeah.
I thought I'd start that way. Then
we have the same last name.
Right, because inheritance really matters when you're giving money to your cousin.
Oh, that's true.
I was talking about my way.
Oh, okay.
Right. No, but imagine this, that you're thinking about inheritance, do's and don'ts is what our topic is going to be called. And we wanted to design a show around the topic of inheritance. There's two sides of it, of course, the person giving the inheritance and the person receiving the inheritance.
Yep.
And we need to understand what goes on and need to understand some of the rules. We need to understand the don'ts, the things not to do at all, to make sure you avoid those.
Avoid the don'ts, do the do's.
I think that makes sense.
Yeah, and that's on both sides, the giving and the receiving. You got to know what they are. That's why we're here.
There's so much things to talk about. So we got a whole show here today to talk about inheritance, do's and don'ts. This show is something that you need to listen to because we're all going to pass away someday.
Yeah, we just don't like to think about it.
There might be a surprise letter in the mail someday where you find out you're a beneficiary or something.
I've seen that happen.
Yeah, I've had clients get a call saying an aunt in California is not donating, so basically put their name on as beneficiary.
I saw one where it was a cousin in Scotland.
Yeah.
Left money to cousins that they had never met.
Wow.
Yep.
Wow, this could be you. But what happens is this. What do you do? What do you do with inheritance and the do's and don'ts? So I'll get started on the show today. Yes, it's winning in retirement. Retirement is many things go on in the retirement years. But winning in retirement is understanding everything you need to do to have a well-rounded, solid financial plan. The more and more successful you are, then you really got to do the estate, the legacy, the planning to make sure the money goes where you intend it to go. So yes, I am starting with the person that wants to give the money and setting up their beneficiaries and things like that. So give me some thoughts to start out, Jeff, on do's and don'ts about just being the person that's setting up the beneficiary and basically thinking about inheritance.
Right. I think we'll be getting into more details about some of this stuff as we go through the show, but there are some things that you can give to your relatives, your children, to people, and you can minimize or avoid the tax and giving it to them just in the way that you're setting it up to be given to them. There are other things that are going to be taxable to the person who receives it. And so if you're charitably inclined, okay, do you want to give money to charity? We need to pick out the right things to give to charity. So there's a lot of stuff to go through, and we've had some plans where we're helping folks give some to charity, some to their kids, some to some other family members, and what's the best way to get it to them so that they get what you want them to get.
Right. So the designing of giving it the best way, there are different levels of tax. We got to start with talking about that because you mentioned tax.
Yep.
And tax could be many things. So let's go through some topics of tax when it involves inheritance.
So the first tax I'll mention is income tax, and that's the tax you pay when you work and you get a paycheck and you get income. There are income taxes on like IRAs. When you take a distribution from your IRA in retirement, that's going to be taxable just like regular old income. So that's one kind of tax. And when you inherit money, sometimes it will be subject to income tax. It depends on what it is. Then there's another kind of tax, which is an estate tax. And there's a federal estate tax that has a very high limit. It's $12 or $13 million this year, but it's a high number. So a lot of people don't really get to that number, but you need to be aware of it if you're close to that. There's also an estate tax in the state level. So Maryland is a state that does have an estate tax. And so you need to be aware of that and what its threshold is. And then there's another kind of tax called an inheritance tax. Maryland does have an inheritance tax. It depends on who you're giving it to, whether or not it applies. And Pennsylvania is a state that does have an inheritance tax that pretty much applies no matter who you give it to. So there's three different kinds of taxes: income, estate, and inheritance tax. And we need to know what they are and how to manage them.
Now, there's a couple of topics I got to say right away. One is the fact that you mentioned estate tax and inheritance tax. And why do you do that?
Well, because they're different. An estate tax is a tax that's owed by the estate. An inheritance tax is a tax that's owed by the person receiving the money. And Maryland is the one state in the country that has both, an estate tax and an inheritance tax. So in Maryland, we need to be aware of both.
So inheritance, do's and don'ts, understand the rules where you pass away.
That's right.
Right.
Where you die makes a difference.
And that's where you pay the tax at.
Right. That's the state that controls the inheritance tax, estate tax, those kinds of things.
All right. So the federal estate tax has been, since 2017, it was changed, and it's indexed to inflation and everything like that. So in the year 2023, the federal estate tax per person is $12,920,000. Is that you're allowed to give to the next generations without any federal estate tax, which starts out in that 45% bracket, depending on really the total taxation and exemptions and everything else you do on the return.
Right. The taxable amount, the highest rate there is 40%.
Yeah. Right. And then what happens is that you had the federal, now combined, a husband and wife would have $25.84 million.
That's a big number.
It's a big number. But what happens is when clients have numbers at this kind of level, there is estate planning to do something called estate freezing. Estate freezing is where, okay, I'm getting near that limit. I don't want to go over it. How do I take things out when you're trying to freeze the estate from growing too fast above these limits where federal estate law occurs?
Right. So we want to, there's a couple of things we want to do. One, can we carve some stuff out so that it's not going to be subject?
Right.
We have to get it out of our ownership in order to do that.
Sure.
And so there are ways to do that, but they're a little more complex. So we need to sit down and go through what they are and get them set up correctly.
Yeah, let's just do some simple things. Estate. What is the definition of an estate?
So an estate is, there's actually kind of two definitions that people think about. There's a probate estate, which is money that's it kind of passes through your will. So it has to be probated. And that's money that doesn't have a beneficiary or anything like that. And the probate estate, there's a fee for probate to go through that. Most people try to avoid that as best they can by using beneficiaries. The other kind of estate is what the federal estate or the taxable estate is. And that includes everything, whether you got beneficiaries, it includes life insurance, death benefits, it includes everything. So that can grow pretty quickly. It doesn't matter if you have a beneficiary on those accounts.
Yeah, the way I picture this is, imagine you're holding a balloon and that balloon has a string to it. That means you control the balloon. Mm-hmm. Now, you let go of that balloon, it floats in the air and disappears.
And you don't have control of it.
No, don't have control of it. So imagine an estate. What is in your estate is if you have control of that balloon.
Right.
If you can control it, yank it back to you, you can hold it nice and pretty. Or I can't really go into any more stories with the balloon. You can pop it on your own, whatever you want to do with your balloon. But that balloon, if you have that string attached, then it's in your estate. If this string is no longer attached to you, then it's not in your estate. That's a simplistic way of trying to explain it. Now, what happens is this. There's federal estate tax, and then there's Maryland estate tax, which I think the limit's stops at $5 million on estate taxes. That means anything above $5 million, you pay tax in Maryland, which is one of the lowest estate taxes at 10%, but that's on top of the other 40% in federal.
That would be federal, yeah.
All right, so this is a very taxing portion of the show where the do's and don'ts is understand where you are. That's the idea, is where is your estate at? If your numbers are way below these numbers we've mentioned, then you might not have estate taxes, but you will have income tax depending on what you own, what's part of the estate. We're going to talk about that. The idea of inheritance tax, it depends on where it's coming from. So in Maryland, inheritance tax occurs if you're giving to someone that's not in your direct bloodline.
Right.
So if I gave to a cousin.
Yeah, if Brian were to die and leave me money, I'd have to pay an inheritance tax.
Correct. Now, that is very true. If Brian passed away, life insurance, and you're the beneficiary, you do not have to pay inheritance tax in Maryland.
Or income tax.
Or income tax.
Life insurance.
That's life insurance. If your beneficiaries, let's say you don't have a bloodline, you don't have children that are the bloodline, and you want to give to nieces, nephews, cousins, people like that, you can do through life insurance and avoid an inheritance tax, which could be that 6 to 10%, depending on who they are.
Right. Yeah. When Brian says direct line of descent, think children, grandchildren, parents, grandparents, and brothers and sisters. Those are the direct descendants. But when you get into the aunts and uncles, nieces and nephews, cousins, and all that, it's no longer direct.
Very, very true. So what we covered so far is just that there's some taxes that you have to think about when you are giving an inheritance. And that's very important if you're receiving it, because you need to know what's going on. That's a big topic for the second quarter. Not going to dive in too deep there. But we want you to know the best way to give. And that all depends on what you own, what you control, what your money is invested in, where your money is, how it's titled. All extremely, extremely important. Make sure you have everything planned out to make it work out the best way you want. The do's and don'ts of inheritance is this. Know what you own so you can make sure it passes the way you like. Any ideas there?
Yeah, and know how you own it. Like you said, the titling is very important, and I can't tell you how many times people come in, they say, well, I've got this. Well, do you own that jointly, or is it just you? Do you have a beneficiary? And like, I don't know.
Right.
So bring a statement. That's
okay, the last minute of this quarter, I got to cover one big thing. That's this. There's a thing called gift taxing. That is when you give while you're alive.
Ooh, okay.
And when they have high estate limits right now, they also have high exemptions where if we do gifting in our current year while we're alive and do proper federal returns, we can avoid estate tax on money if we fill out these gift taxes properly. The hardest part is that the high limits fade away in 3 years. At the end of 2025, we go back to old rates from 2017, which would mean that if your portfolio, your estate's worth under $5 million, you're going to have a federal estate tax issue. And that's something that you have to understand, that it will pull back. And basically right now you have no estate tax, and then boom, you have estate tax.
Right.
Make sure you know what's going on there.
Yeah, now's the time to plan.
Right. So Akers Financial Group, we designed this firm to be independent. We're local. We don't report to a big company on Wall Street. We report to you. We have offices in Forest Hill and Lutherville and clients all around the country. It's so easy to begin winning in retirement. You can give us a call for a free consultation with one of our team of advisors. Call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to AkersFinancialGroup.com or give us a call at 833-946-7384 to start planning for your retirement now. Never say, just send me the check. We'll explain in just 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, certified financial planner and founder of Akers Financial Group. And here with me today is Jeff Akers, also a certified financial planner practitioner. And good morning, Jeff.
Good morning again, Brian.
You ready for second quarter?
Oh, yeah, we're ready to go. Just to be clear, Brian is older than me, and he's been at this for a really long time, since, 91, 92?
It cut me short 5 years, but that's okay. 1987, yes, in college, I got a assistant financial planning job, and then went from there.
So I was only counting post-college.
Well, December 1990 started my first company.
Oh, there you go.
Yeah.
Oh, wow.
Yeah.
Okay.
So it's a real crazy thing when you go back and say, what did I do in my 20s? Was I really thinking? No.
Got married, started a company. Yay.
I believe in planning. I love planning, and planning matters in everything in life. Sometimes in life, I've learned that I need to plan better. One of those things was when my kids were young. Yes, I have a daughter and I have a son. My daughter is one of those kids that always is listening. She goes to bed, she's always listening. And so I thought I could eat ice cream after she went to bed one night. Right, so I grab my ice cream, I sit down, and like, ice cream. And then she comes out, I want ice cream too. And I'm like, no, you can't have ice cream. But what happens is that, how do you say no to your daughter, right?
Right.
And so I had to share. Yeah.
Boy, how late did she stay up?
As late as she had to. And she still does that to this day. All right, so the reason I tell that story is this, is that we get an inheritance. There's somebody who wants to share with you.
Oh.
They want some of your ice cream.
There's a partner.
Oh, there's a partner, yeah. Now, Uncle Sam loves the fact that people that pass away don't vote. And they love the fact when they pass away that the inheritance is the easiest thing for them to tax.
Yeah, they can take that.
Right, and so they tax that, and then the receiver, the people who are getting the inheritance, is happy to get whatever they get.
Mm-hmm.
the person that gave it has passed away. They're not happy that there's taxes on their success. And so there's this whole way of figuring this out on how to reduce taxation.
So you just said your daughter was Uncle Sam. I find that funny.
You do?
I do.
Okay.
Yeah. She took your ice cream.
Well, she didn't borrow it. She shared my ice cream. So now as she's older, I try to make sure because that she goes totally asleep before I sneak my ice cream.
Right.
No, thanks. Oh my goodness. Back to the show. Inheritance, do's and don'ts. What happens is this: you could be the giver, the person lining up to give your legacy to your inheritance, and we want it all to go to the ones we want, and we want them to get all of it, not part of it. No, the ice cream, I didn't want them to get any of it, so that's not really a fair example. But in this example, I wanted to inherit the ice cream. Right. Sorry. I'm stuck on that. Moving right back to the topic of this quarter, that's this. Don't ever just say, send a check. And the reason is that we've had situations where clients call us and say, well, my mother passed away, my aunt passed away, and their broker's handling it. They're just going to send me a check.
Ooh.
And what's the first thing you say, Jeff, to that?
Have they done it already?
Yeah.
I want to know if they've already sent it, because if they haven't, we might want to stop them.
What have you signed? Can I see it?
Right.
That kind of thing. Because what happens is this. Now, this is not saying that people don't know what's going on when it comes to inheritance, but a lot of times the person handling the paperwork is not the advisor. It's someone else, and they're just processing the paperwork.
Right. The person who passed away was their client, and it's kind of like Uncle Sam. Okay, they're gone, so let's take what we can get. And in this case, they might be saying, all right, you're not my client, so just go away as fast as possible.
All right, so let's talk about checks. All right, so first quarter, talking about taxation. So let's talk about this sharing with your inheritance. So if there's a bank account and you are joint on the bank account, the money goes directly to you. Do you have to pay tax on that?
No, that's not taxable.
That's not income taxable.
Correct.
It could be estate inheritance-wise, depending on who the person is.
Right. Half of it could be in a joint scenario.
Right, and there's a long story there. Basically, you have an interest in the property if you're joint.
Right.
If you're a beneficiary, now if you're a beneficiary at a bank, they call it payable on death. If it's a brokerage firm or some other accounts, they set up called transfer on death. Both of them avoid probate, which is the process of changing title. And by doing the titling with payable on death, transfer on death, the account transfers to the people that are listed. It's a very simple process. You have to identify who you are. You have to have a death certificate and then explain, yes, I received that money. And if it's a bank account, there's no income tax.
Right. That's correct.
Alrighty. So imagine it's a stock brokerage account and we have stocks.
Okay.
And those stocks is family heirlooms. They've had a long time. On what happens upon a death if the person's a transfer on death beneficiary?
Okay. So it's a transfer on death. So you didn't have an instance of ownership before they passed away. That means on the stocks, you get what's called a step up in cost basis. Your cost basis is whatever the value was on the date that the person passed away. So in simplest terms, if immediately that day you said sell the stocks, you wouldn't have any tax on that. Right. Receiving the stocks, you don't have any tax on that, but down the road you might have a capital gain tax when you sell it.
Right. So the main idea there is if the stockbroker or the investment firm, you have the money, what you got to do is have a beneficiary. Make sure you have a beneficiary, because without a beneficiary, it has to go through probate.
Yep.
And probate is run in Maryland through the county that the person lives in. And you got to go there and file paperwork. And it takes up to 9 months just to get paperwork and everything in minimum, and longer than that, depending on everything that's involved.
Right. It can take a little while to get the estate settled, depending on how complex it is.
If you only have a will, the will is an instructions for probate. Basically, only things that go through probate would your will control. And so that's a whole nother topic, whole nother show, which will bring attorneys in for that. But the idea would be understanding that if you have a beneficiary, which we highly recommend, that beneficiary receives individual stocks, goes straight to them. Now, the thing about the check, one of the things that we found to be the biggest problem would be, first of all, retirement accounts where people are the beneficiary.
Right. So a traditional IRA, a traditional 401k, 403b, TSP, those kinds of things.
Right.
Yeah. That on those accounts, there was a tax break when the person put money into it, when they take money out, it's going to be taxable. And just because they've passed away doesn't mean that it's no longer taxable. It will be taxable to whoever receives money from that account.
Absolutely. So what he just said is this: the deferment of retirement money over time, over a lifetime, that money stays deferred, and somebody's going to pay the tax.
Right.
The whole required minimum distribution is trying to get it out during our lifetime, but if we pass away, it's then taxable to the next generation. Is it taxable all at one time, Jeff?
No, it doesn't have to be. If you tell the person, just send me a check, then yeah, it is.
Right, because just send me a check means they liquidate the account, they send you a check, and then they take mandatory taxes out, and you get a check.
Right, and it shows up on your tax return the next year, and you might even owe more.
And you would owe state because they don't mandatory state taxes on that thing.
Right, but you can take a retirement account like that and put it into what we call a beneficiary IRA.
The old BDA.
Yep, and when you do that, you do have to take some of it out every year, but you've got 10 years to take all of it out. So you can kind of pick and choose what's a good tax year, what's a bad tax year, take the minimum in a bad tax year, and if something happens where you're gonna have really low income, take a chunk of it out in that tax year.
And the Secure Act 2.0, actually it was 2020 in January that year, they came up with a new idea where we no longer get to stretch these withdrawals over a lifetime. And now they limit us to generally 10 years unless there's a special situation. Somebody's a child, somebody is a child disabled. There's some other eligible beneficiaries that can stretch it longer.
Right. And there is one special beneficiary, and that's a spousal beneficiary. And there's some rules about this, but the spouse can actually inherit that IRA and just make it their own IRA. So then they don't have required distributions unless they've reached that age as well.
So do's and don'ts that we've learned with this most recent law is this: if you're the spouse, that you should not be split primary beneficiaries with the spouse. Because one of the weirdest things is this: is if you're the spouse and your husband says, "Oh, I'm going to give you 25% and the 3 kids 25% each." Now the spouse can't transfer to their name, and they have 10 years to take it all out.
Right.
Because of that, we say divide the account out and have an account for the kids that goes to them and one account that goes to the spouse, and then make the spouse 100% of that.
Right, because the account has to have a sole primary beneficiary. That's the spouse. Sure,
absolutely. So IRA beneficiary forms is something you need to keep a copy of and check your beneficiaries on a regular basis to make sure that the company it's through has it set up right. Because what you wrote down overrides your will, overrides any other intent or promise you might say verbally. Like you say, "Hey, I got an IRA for you." That doesn't mean anything if the paperwork says you're giving it to someone else.
Right. The person who thinks they're the beneficiary comes in and says, "Hey, they told me I was going to get this." And the company that has the account says, "Here's the form they signed that says you don't."
Now, the sad part about a retirement account that has, let's say you're the beneficiary of it. If you say to them, "Just send me the check," they send you that check. You call Akers Financial Group and you say, "Oh, I got my check from my mother's retirement account. What should I do with it?" And we're like, "Did you get the check yet? Don't cash it." Because as soon as you get that check, once they pay it out, you cannot undo that.
Right. You can't put it back.
And that's a shame because it makes all the taxes all payable immediately.
Right away.
And so for IRAs, we rather have it go to a beneficiary deferred account. And many times we have to set that up at the existing firm that owns it. Mm-hmm. That's the custodian of it, where it's held. And then what happens is you get a beneficiary account. The thing's transfer in kind, meaning what stocks was in a mom's account will go into yours. Yep. And then it's there. And then you can decide what to do. By having it in kind, nothing changes. And that's a very important piece of understanding. Never say, just send a check.
Right. And there is, real quickly, just one kind of account, a Roth IRA, that it's not taxable, but you can defer taking that money out for 10 years. And that can be a really good idea because you maximize your tax-free money by doing that when you receive it.
Can you say it one more time?
So a Roth IRA is not subject to income tax, but you can stretch that out over the 10 years like we talked about before. And by doing that can be a really good idea because you can maximize the amount of money you receive tax-free by stretching it out.
We want you to understand just saying send a check is not going to be the wisest choice when receiving an inheritance. Make sure you understand what's going on.
Right.
Many things can change our mind over time, you know. Well, one of the things I want to do as we close out the second quarter is tell this little story, Jeff. Are you ready for this one?
Okay. Are you going to let me participate or are you just going to tell it?
How about you be the actor?
Okay.
You play the I invite you to lunch roll. How about
Right,
that?
right. I'll be the actor.
All right. I'm going to invite a friend to lunch, and that friend is going to come in. I'm sorry, I can't do this. All right, trying to act this out is funny. So basically, Jeff walks in the door, and I say, hey, how you doing? And then what do you say, Jeff?
Did you see what happened to the stock market this morning? I lost a lot of money.
Yeah, I say, I saw what happened. What do you want for lunch?
Lunch? How can you be thinking about that?
I have a retirement plan that's just independent of what happens on Wall Street. I'm fine.
Well, good for you.
That's a little snarky, isn't it? Yeah. Well, the problem is this, is that if the noise of Wall Street affects you with every decision in your life and affects you how you feel emotionally, you need to rethink how you do your investments. And that's what Akers Financial Group does when we talk to people about their financial plan, their retirement plan. Akers Financial, we guide you to create a plan so that you can thrive no matter what financial storms can come ashore. Give us a call at 833-WIN-RETIRE and schedule a free in-person or Zoom meeting. That's 833-WIN-RETIRE. That's 833-946-7384. Or visit our website, AkersFinancialGroup.com. Scroll down to the button on our homepage and schedule a meeting there. Call 833-WIN-RETIRE. Go to AkersFinancialGroup.com. Will your heir or your heirs get what you give? We'll cover that in the second quarter in just 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
I'm Brian Akers. Here with me is Jeff Akers. We're certified financial planner practitioners from Akers Financial Group. What that means is that we are financial advisors here to advise you on your retirement. When you work with us, it's all about your retirement, not about anything else. It's not about us at all. It's about really, truly trying to get to know you and understand what's going on in your life. Now, this show, Winning in Retirement, is general in nature. What that means is we're talking the topics and what's going on, and so that you can try to think through what's wise and understand the importance of having an advisor alongside to help guide you through these decisions. And that's why we have this show called Inheritance Do's and Don'ts, understanding that the advisor guiding you through this is someone that you need to have on your team. If you're the one giving the inheritance or receiving it, you need to have a proper plan. And so this third quarter, the second half of the show, the topic is this: will your heirs get what you give?
Boy, I sure hope so, but we got to be sure.
Right. So how do we know, or how do we check this, Jeff?
Well, we have to plan. We look at, you've mentioned earlier in the show about titling. You know, how are things titled? Who owns what and how? We've got to check our beneficiaries. Who are the beneficiaries? Maybe I'd started a job, 30 years ago. I wasn't married yet. I named a beneficiary, and I haven't even thought about it yet. Or again,
yeah. Well, I had one the other day. They bring out their pension statement, and they have their wife, and the contingent are the first two kids.
How many kids do they have?
They have a third kid.
Oh,
19 years old.
Too bad.
Not listed. Whoops, I did that a few years ago. Yeah, how old is your daughter? Oh, 19.
Right, 20 years ago.
Well, it's one of these things that when you think about financial planning, you say, well, we want to check your beneficiaries. Do you have a copy of them? And the answer is always no. Do you have a copy of any paperwork that was submitted? Well, then we have to then do the research. You have to go out and get it and have them send a copy of the beneficiaries to us.
Right. Sometimes on like 401ks, retirement plans, we'll have you log in to your account and we'll look around and see, okay, who's listed? Is anybody listed? Can't tell you how many times I've looked in, oh, look, there's nobody listed as a beneficiary.
Especially when the company changes their 401k provider. They say the information transfers over. The reality is
it doesn't.
It's not on the webpage there. You have to prove it. And sometimes that's good. After someone passes away, you can say, well, here, this is what it should be. And they'll agree to it.
But most of the time, people don't hold on to that form that they submitted 20 years ago.
So we sit down with clients. We look at their 401k plan online, in the office, on the big screen TV, and we cover, this is your website. Let's hit the profile, hit the check beneficiary, who's listed. And then they go, okay, that's good. Second marriages can be a little dicey, so we try to be careful how we click that button, because then you have a punch going on if it's not done yet.
Hopefully they have a good sense of humor.
But getting it done right is the key. Now imagine this, that you have accumulated wealth in your lifetime. You have different accounts with different titling. Sometimes we have an account, we start it when we're a teenager. Right. We have our name on it, might have our mom's name on it with us. Right. And then when we're 45 years old, it still has you and your mom's name on it.
Right.
And then you realize, yeah, it shouldn't be that way.
Right. I should change that.
These are all things that need to be cleaned up to have a proper estate plan. Now, Jeff and I have had many situations in our careers together working at Akers Financial Group. One of them was when I got a client. I went to visit. The husband had passed away, and there's a room full of stock certificates and statements, and the person had done a lot of direct investing everywhere. I came back and said, Jeff, you need to go work on that one. Do you remember that one I'm talking about?
I don't remember that particular one. I remember another one that came in that was the same situation, though.
Yeah, well, this one's a long time ago. But what happened was that you had to go and spend multiple days, and we, for 3 years, had to watch the mail for any other direct investment he had done. So the thing is that in the 70s and 80s especially, dividend reinvestment plans were very hot. And what that meant is they would actually reinvest the dividends on the stocks, and people would have a collection of these stocks, because that was a way of investing and sort of just consistently invest, and worked very well financially. The hardest part is that it was terrible when it came to estate planning.
Hard to clean up down the road. So imagine you've got each stock has its own account. And so every account has its own titling, its own beneficiary, if you name a beneficiary, and so forth. So when you pass away, now each individual stock has to go through either the probate process or the claiming process if there was a beneficiary. On the other hand, you can take those stocks and put them into a brokerage account. Now they're all under one account. You name the beneficiary one time, and upon your passing, it's a whole lot easier to just do one set of paperwork rather than 30 or however many stocks there are.
We've also checked beneficiaries on life insurance. So sometimes people do their auto and home, and then the insurance agent will sell them a life insurance policy. And many times in this case, they don't take time to fill out the beneficiary form. They just write the word estate. Now, why is that a problem?
Because now it's going to go through probate, and that death benefit will be subject to fees. We told you before that life insurance is income tax free, but it's not probate fee free if it's going through the probate estate.
So if you list estate, you better have a good reason on why you listed the estate. Now, if you're using trust and designing irrevocable trust and doing a lot of the more advanced planning, you would name the trust as a beneficiary.
Right.
There are a couple cases we made the estate so that we could get a guardianship and some other things set up and a special needs trust set up. There's just so much information. It depends on when you want to give money to your heirs, knowing who they are and how you want them to receive it is the key part of setting this all up. Because many times you don't want to just give all the money you accumulate in your life to someone all at one time.
Right. And I'm going to use almost never. So I never use never.
Sure.
But almost never do you want to name your estate as the beneficiary of something. If you're going to name the estate as a beneficiary, just don't name a beneficiary at all, and then we'll go through the estate, through the probate estate. So you can really have a hard time with taxes. The inheritors will.
One of the analysis that we do for clients is it's called estate flow. And we write down, well, these are the assets you have. These are the beneficiaries that we believe are. This is what your trust says, your will, and everything else. And this is who gets how much money. Mm-hmm. And then we look at it, and they look at it, and they go, I didn't want that. I don't want that to work out that way.
Yeah, I've had a case like that where we listed out, here's all the people you want to have money, how much do you want them to have? And we just broke down the estate, and they had charities and whatnot. And so we finally reached a point where they said, okay, we're satisfied with that. But it was a big old spreadsheet to get it all taken care of.
Yeah, one of the things that happened recently is one of my clients for a long time passed away. The husband did. And the wife's also been a wonderful client for a long time. And the idea is that about a month ago, we had our talk. He's slowly dying of cancer, and he passed away. And the hardest part was understanding how much should go to the wife, how much should go to his son, and figuring that all out. And then redoing the beneficiaries and getting things set up to pass the way he wanted. Mm-hmm. It's not a fun thing to do. But imagine that our advice is this. When you're thinking about inheritance, you look at it this way. If I passed away tomorrow, how do I want it set up? Then you invest. You do everything else as if you might live forever, but you have the planning done as if you might pass away tomorrow. Now, in the case I'm talking about, he knew he had limited days, but that idea of planning became something we had to faster because of limited days. Most of it was already in place. We just had to make sure it was going exactly the way he wanted it to go.
Right. And there are times, like you're saying, where something happens, you know that your time is limited, but there are other times where something happens and it's sudden.
Right.
And so you can't wait to say, oh, well, once I know I've only got months to live, then I'll do this. You can't do that because you might not have months to do the planning.
Yeah, some of the sad things in our careers, we work with a lot of military and police officers and first responders. They have high risk jobs. They come in no matter what age, and they don't have a will. They don't have an estate plan done, or even enough life insurance, and it's because they've never taken the time to think that way.
Right. They're focused on they're going to live forever.
Absolutely. And they don't want to think in a negative way doing their jobs, which I understand. But the concept of what if something happened tomorrow, have everything set up right, and then just go live your life. Mm-hmm. I think that mindset will allow us to have proper planning done. Many times the military and police especially have the ability with an attorney to have their wills and things done for free.
Right. If you've got something like that through your job, then take advantage of it.
Absolutely. Having a will basically says if I didn't put a beneficiary on anything, my will is going to say what happens to my money, and so it goes through probate. It will actually have instructions on who it goes to. Now, Maryland has sort of their own rules if there is no one to give to on the test. That's state law.
They've got a will for you if you don't have your own.
Right, and some situations when you have no family at all, it could go to the county's Board of Education, sort of the worst case scenario.
Yeah, well, if you're married and you have some kids, then your spouse might be disappointed to know that they only get half.
And they have to split.
And then the rest of it gets split between the kids, the other half.
Yeah.
So if you don't want that to happen, get a will, name beneficiaries.
Will your heirs get what you give? The reason we make this important is there's the whole tax idea, and then there's the idea of how is it structured? Is it structured the way you intend it, what you want to do? Second marriage situations, they'll have a beneficiary be their child, and the child's 12 years old. The problem is that there's no guardianship or any type of money trustee for that inheritance, so it ends up being the ex-spouse being in charge of the finances of the 12-year-old in this example.
Right, and maybe that's fine. Maybe you trust your ex-spouse to handle that, but maybe you don't. So you need to name things appropriately.
Make sure your heirs get what you give through proper planning. That's the key to it. No matter how large your estate gets, understanding the flow, the estate flow, very, very important. Take time to do that. At Akers Financial Group, everything we do is about you. Your retirement and estate planning is as unique as your fingerprint. When you sit down with us, we'll start by taking a look at your financial fingerprint. That is where your money is. How much do you have? How much you're earning? Then we'll talk about what you want your retirement to look like and feel like. That's your retirement fingerprint. Perhaps you've been sold something, regardless of whether you needed it or not. Not at Akers Financial Group. With us, your retirement money follows your financial fingerprint. It's a retirement plan based on your unique fingerprint, and that determines where your money goes. It's not about us. It's about you. Give us a call at 833-WIN-RETIRE and schedule a free in-person or Zoom meeting. That's 833-WIN-RETIRE, 833-946-7384, or visit our website at akersfinancialgroup.com. Scroll down to the bottom of the homepage and click the Schedule a Meeting button there. Call us at 833-WIN-RETIRE to go to our website, akersfinancialgroup.com. The amount you are about to inherit depends on this. We'll explain in the fourth quarter in just 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Yes, indeed. Welcome back to Winning in Retirement. Welcome to the fourth quarter of Winning in Retirement. I am Brian Akers, and here with me today is Jeff Akers. We're both certified financial planner practitioners from Akers Financial Group, located right here in Maryland, but we work with people all around the country. So it's a matter of getting the first meeting to sit down and talk with one of our team of advisors to go over where you are currently. Today, we've been talking about inheritance, do's, and don'ts. If you happen to have missed anything during the show, you can go to our website at Akers, A-K-E-R-S, financialgroup.com. We go to that website, and you can check our radio tab, and you can hear past shows, and even this show will be up online very soon. all you need to do is check that out. You can also go to podcasts. They're out there also. So AkersFinancialGroup.com to check out past shows. Inheritance, do's and don'ts. We barely covered the topic so far. We had taxes to cover first.
Yeah.
Then we talked about the idea about the check, about
Right.
don't ever just ask for the check.
Right.
And then we talked about making sure the heirs get what you give.
Titling and beneficiaries.
Yeah. And then the fourth quarter is about the winning time. It's about finishing the inheritance, finishing the game.
Right.
So we got to give the greatest advice you've ever given right now, Jeff.
Right now,
Right now.
give us a call. Come see us. Let us help you walk through what to do.
So that's the best advice. It's just you got to start.
Right.
Right.
Get started.
All right. So the topic of this quarter is the amount you're about to inherit depends on this. And that's exactly what you said, which is give us a call to sit down and talk about your situation.
Right.
So we're talking to the people that are receiving the inheritance to make sure it's received properly. Now, our clients, every one of them, we plan for the inheritance to pass properly, but we do have to go through all the work it takes to get it set up right.
Right. So we help the person who's leaving it, and then after they passed away, we help the people who are receiving it as well.
All right, so Jeff, give me just a little story about any of your clients who have passed away, and then you meeting with their kids and telling them about the client, what their intentions were with the money.
So there's one that's kind of funny. The mom had already passed away. The dad passed away. And so we were talking about, okay, here's how much each one of you will inherit. And we went through it with everybody. And afterwards, one of the kids says to me, I thought my parents were broke.
Yeah.
I would take them to lunch and I would treat. And now I'm inheriting $250,000 from them? Well, it's like, yeah, that's why they had $250,000. So we helped them to get money in a way that minimized taxes. There was some IRA money that they're taking distributions from, and there was some bank money that there wasn't any tax on, so it's what's the best way to use that money.
Yeah, absolutely. So what happens is you got to understand where the money is and then how to receive it. So one of the hardest things is when you are a beneficiary and not in charge of the estate is getting information and knowing. So we always ask them to find out for statements, for information where it's coming from, to get stuff in writing so we can read and try to help and guide them to what they need to do.
Right. So for the person that's leaving the money, the titling is critical, and whether or not you have beneficiaries and who those beneficiaries are is critical.
Now, if they're clients of Akers Financial Group, we can walk them through it. It works out very well when it comes to paperwork to be able to explain what's best for that beneficiary through meetings with them and their goals, and then saying, well, this is what's coming from the client who's been our client for, say, 20, 30 years. And then now the money's coming to you, and this is what their intent was. It was to help you through your retirement years, and this is how we can do it. And then we walk them through a process.
Yeah, last time you mentioned someone who accumulates a bunch of stocks directly with a transfer agent and is dividend reinvesting and stuff. And I had a case where the man had been doing that. His daughter was a client and says, can you come talk with my dad? He's, kind of on a decline, and we might want to get this straightened out. And so he had a bunch of stocks all over the place. But while he was living, we were able to get them into a beneficiary kind of account, a TOD account. His wife was still living, so we named her as the beneficiary. And when he passed, then all we had to do was one claim for her to get the money into her name. It was much simpler than it would have been doing multiple claims on those stocks.
Absolutely. Now, in estate planning, if you have anything that's titled just in the person's name that passes away, it has to go through a probate process.
Well, if it's just in their name and there's no beneficiary, then that's true.
Right. So, like, there's life insurance companies that you bought a mutual life insurance company, and then they became a stock company, and they threw stocks at you for free. Many people forget about these.
Right.
And then what happens is after someone passes away, oh, look what I found. I have 27 shares of MetLife or Bright House or
something.
Any version of that.
Right.
And then you have to open the estate just to get that stock transferred over.
Yeah, even the person when they were alive, all they know is, hey, I get a dividend every 3 months from this company.
Right.
Oh, that's great. I'll set up direct deposit so I don't have to think about it. And that's the extent of what they think with those stocks. But there's more that should be done.
Absolutely. Now, one of the things I was thinking about is really about legacy and legacy planning, and really understanding about you want amounts to go. Now, in a perfect design, you would want everything to be life insurance because it's tax-free.
Right.
And you can state the beneficiary. If you put it inside of a trust, you can build a lot of wealth. And this was sort of how the Forbes family was able to keep the Forbes family very wealthy over the years, was through a lot of layered life insurance and trust. And that involved a lot of tax-free giving of things.
Right. That's a way to maximize what you're giving to the next generation, and not just what you're giving, but what they're actually receiving.
So that gets to my point is that the younger you think about legacy planning, the more likely you could add life insurance as a solution. As we get older, it's harder to get life insurance, and it's cost a lot of money. It might not be as affordable as you might want.
Right. When you're young and healthy, life insurance is less expensive. When you're old and starting to have some doctor visits, it gets more expensive.
Absolutely. So what happens is that when you're trying to work on the inheritance, by having planning, you can design things to go the way you want. So if you want to give some money to charity, there's ways to design what is best to go to charity. What's your favorite type of account to go to a charity, Jeff?
So there's two. One is a traditional IRA or retirement plan, because that's going to be taxable to whoever gets it. The charity doesn't pay tax. The second is non-qualified annuities.
Sure.
Because whoever receives that is going to pay tax, at least on the interest. They won't pay tax on the basis. But if you leave it to a charity, then again, the charity doesn't pay tax.
Right. So a non-qualified annuity has a tax deferral as you reinvest the interest. So many great savers will look at a fixed annuity or a variable annuity, and they'll put the money in, and then whatever it grows over the years, it grows tax deferred. Then the beneficiary has to pay tax on all the gain. And sometimes they can defer it up to 5 years in some cases.
Right. But it's only 5 years.
Right. So one of the things is that if you're a great saver and have legacy in mind, there are life insurance designs. Instead of putting into a non-qualified annuity, you can put that money into life insurance where the growth would then be tax-free versus taxable in a deferred annuity.
Right. So what you give to your kids, for example, life insurance would be fantastic, tax-free. Roth IRA would be fantastic, it's tax-free. What you give to charity, the traditional retirement accounts and non-qualified annuities, you're maximizing what goes where you want and minimizing what's going to Uncle Sam through income taxes.
Imagine that when you want to eat your ice cream or hand over your ice cream, there's someone there to share. It's the IRS is there to share.
Right.
And we want to cut the IRS out. One combination you can do is through charitable planning and direct giving and life insurance. You can actually create where there's very little taxation to your family upon death if you set things up right.
Right. So that's something that we've done. We'll set up irrevocable life insurance trust, and we'll use money to fund life insurance for the kids, and then give other stuff to the charities.
Yeah. A financial advisor is someone that's going to take a look at where you are and understand the titling, ask for copies of the beneficiary, and then understand what you're trying to accomplish. And then based on that, we'll then work the plan, meaning that we'll try to figure out the best way to hold things and title things based on your goals. Now, the hardest part is we want to use money and give money. And we want to give money when we're done using the money.
Right.
So there's a whole combination of it's going to be in your estate as long as you hold the balloon, as long as you're holding a string attached to it. And that's okay because we need money to live off of.
Right.
But you got to build this plan around all of your goals, and you got to have a plan that can work no matter what happens.
Right. And Brian had a client one time who said, my goal is to give as much as I can to charity. So tell me how much I need to live on and develop a plan around that. And that's how much that he kind of held the string on the balloon. And then he named beneficiaries that were charities for things and maximized things through beneficiary designation so that the taxable money went to charities and such.
Yeah, there are so many planning solutions when it comes to inheritance. Most of the time, we cannot cover anywhere near the topic in a radio show like this.
No, nowhere close.
We can't even do it in one of our presentations. We have to do it one-on-one in planning meetings.
Right. We meet multiple times to go through this so that you understand what you have and what we need to do in order to get it to go where you want.
Absolutely. One of the neatest things that we've done over the years is charitable gift annuities. And this is where someone loves a charity. They want to give money to that charity, but they also need income. So they're afraid to give to charity. And so a charitable gift annuity is where, especially as you get older, maybe 80 years old or so, you give the money to charity and then they give you a quarterly payment that comes in as income. And then you have a charitable write-off. A portion is the charitable, you can write off the tax off your taxes. But then what happens is when you pass away, the charity gets whatever's remaining in the charity and the annuity that you set up.
So they get that remaining amount to use, and you've fulfilled your goal of giving to that charity.
Right, and it's a more of a permanent thing for you too. That's definitely permanent. But the idea is you create the income flow and you give it going to the right destination, which is great.
Right, so it's important to plan. You need to plan when you're giving, and you also need to plan when you're receiving so that you maximize what you get and then you use it the best way possible.
All right, the inheritance do's and don'ts. That's the name of the show today. The idea, what you should have learned is this. There's income tax, estate tax, inheritance tax, possible gift taxing if you try to solve the problems while you're alive. How you receive the money over time, very important. Don't ever ask them to just send you a check. Understand where it's coming from, how it's titled, and how it will be taxable to you when you do receive it so you can make all the right choices. Make sure if you are the person that won design the properly drawn estate plan, that your heirs will get what you give. And then, of course, you need to have a financial advisor to guide you through this. We covered all this on today's show, Inheritance Do's and Don'ts. We want you to win in your retirement by taking advantage of the opportunity to begin planning with us at Akers Financial Group. To schedule your free meeting with one of our team of advisors, go to AkersFinancialGroup.com, scroll to the Schedule a Meeting section, and let us know you'd like to schedule your free meeting. That's AkersFinancialGroup.com, or you can give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to AkersFinancialGroup.com or give us a call at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.